Hello, everyone. Good afternoon. On behalf of my partners, Don Ledoux, Aaron Peabody, and myself, we're excited to welcome you to our quarterly town hall, the second one for this year. We appreciate you joining us today, and we plan to share relevant insights and help you navigate this evolving environment we have had for the start of this year. Our theme for this quarterly town hall is State of Play, Discipline over Emotion. The title is a nod to the upcoming World Cup being held here in North America starting this June, and it reflects some powerful parallels between soccer and investing. Pele famously called soccer the beautiful game, and what makes it beautiful isn't just the goals scored, it's the patience, the positioning, and the discipline that plays out over a full 90 minutes. As we head towards another World Cup, it's interesting to listen to what the game's biggest stars actually emphasize. It's rarely emotion, it's rarely adrenaline, it's discipline. Lionel Messi said, "You have to fight to reach your dream, you have to sacrifice and work hard for it," meaning that you have to give it your all and be prepared, and you can never be complacent. Cristiano Ronaldo says it even more bluntly, "Talent without working hard is nothing." In markets, talent doesn't matter much either if discipline disappears when conditions get uncomfortable. And Mbappe has said, the most important thing is staying focused on what you can control. That's a powerful reminder in volatile markets, where so much of the noise is completely outside of our control. Here are the 7 topics we're going to focus on for our conversation today. Everything from the economy to fixed income, the equity markets, and the international markets. Let's start with the economy and the current state of play. In soccer, when a controversial call happens, the referee goes to VAR, the video assistant referee. You see the signal, they head to the monitor, they review multiple angles before making the call, and the goal is to review the play so that they can make the correct call. That's exactly the approach our economics team is taking right now. The key issue under VAR review is the surge in oil prices since the Iran conflict began on February 28th. This matters because historically, major oil shocks, the Arab embargo, the Iranian Revolution, the Gulf War, the Iraq War, and the spike ahead of the global financial crisis have more often than not been followed by a recession. There's one notable exception, the sharp spike at the start of the Russia-Ukraine war. Some of the dynamics from that episode gives us confidence that the U.S. economy can avoid a recession this time as well. There are a few reasons why. First, the U.S. is now a net exporter of oil. It's not as sensitive to spikes in oil as previously. Second, energy expenses are a much lower portion of our daily budgets than they have historically been. And third, the economy entered into this oil shock in a stronger position, with manufacturing still in expansion and labor market conditions remaining healthy. Taken together, we continue to believe the U.S. economy is on a path that steers away from recession this year. What also reinforces that view is our Fab 5 real-time indicator dashboard. This framework is color-coded. Green signals acceleration, gray indicates stabilization, and red points to stress or contraction. Right now, what stands out is that there is no red. As a result, our economists continue to expect steady growth through the year, with overall GDP growth tracking around 2.4%. The consumer is of particular focus. A key factor supporting our outlook is increased household cash flow, especially from tax refunds. This year, the average refund is expected to be $1,000 more per household, totaling about $140 billion in aggregate support for spending. The near-term offset, of course, is higher gasoline prices. But $1,000 is a significant buffer because to fully neutralize that boost in tax refunds, gas prices would need to rise to $5 per gallon and stay there through September, roughly 6 months. Now, let's turn to monetary policy. The Federal Reserve is about to get a new coach. Kevin Warsh is expected to take over for Jerome Powell as the Fed chairman in May and become only the 17th person to serve as the Fed chair. Overall, we think Warsh is a strong choice. He brings a rare combination to the job. On one hand, he understands how the Fed actually works. He's been there before as a Fed governor about 15 years ago, from 2006 to 2011. And on the other hand, he understands how markets react because he's also spent time on Wall Street, works with the family office, is on the board of a few big companies. But his first day at the Fed could be tense. Warsh has been a pretty vocal critic of the Fed over the past 7 years in his speeches and his writings. He's pushed back on the central bank's heavy intervention in markets, especially large-scale treasury purchases, and he's argued that the Fed has been too transparent with its policy to the public, effectively talking itself into a corner. Another factor contributing to the awkwardness, there's roughly a 75% chance that Jerome Powell stays on the Fed board through the end of this year. Historically, former Fed chairs tend to step away once their chairmanship ends. Warsh will have to pay attention as markets often test new Fed chairs. Some of the noteworthy examples include, in 1980, Paul Volcker faced soaring inflation in the middle of a deep recession and had to raise rates, which compounded the near-term weakness in the economy. In 1987, Alan Greenspan had barely been on the job for 2 months when Black Monday hit, the single largest one-day drop in equity market history. When Jerome Powell took the reins in 2018, we got Volmageddon on day one, the biggest spike in volatility we've seen up to that point, and the first time the Dow fell more than 1,000 points in a single day. Warsh is stepping into the role during a challenging period. Inflation remains elevated, and the labor market is showing some signs of softening, especially with some pressure from AI. Add to that the potential political pressure, with the president openly arguing that interest rates should be lower, and that is a recipe for an uptick in volatility. How Warsh balances credibility, independence, and policy implementation will ultimately define his tenure. Overall, our expectation is that the inflation spike caused by tariffs and energy prices will likely be temporary, and we still believe the Fed will have room to cut rates one more time later this year. Now let's shift gears and talk about the fixed income market. We like to think of bonds as the goalkeeper or the backstop of a portfolio. When equities struggle, bonds have often stepped up. And as the chart shows, the bigger the equity pullback, the more bonds have tended to help. For example, when equities were down 0 to 5% over a 3-month period, bonds were up about 0.8% on average. When equity markets fell by more than 10%, bonds were up roughly 2.1%, helping to cushion overall portfolio volatility. Looking ahead, despite the rise in interest rates we've seen year to date, we haven't changed our year-end outlook for the 10-year Treasury yield. Our base case remains that the 10-year finishes 2026 around 4.25 to 4.5%, supported by modest economic growth, no major job losses, one Fed rate cut, and continued strong demand for treasuries. For yields to fall meaningfully below 4%, we'd likely need a recession and significant job losses, which is not in our forecast. On the other hand, for yields to break above 5%, we'd probably need growth north of 3% or inflation to reaccelerate in a sustained way. We do not see that as likely, especially once the Iran conflict ends. From a positioning standpoint, our preference remains firmly with higher quality bonds, things like treasuries, investment grade corporates and municipals, over riskier areas like high yield. Yields on higher quality bonds are sitting well above their 15-year averages, while high yield yields are closer to the lower end of their historical range. So valuations are more attractive in the higher quality space. Investment grade bonds offer roughly 70% of high yields yield, but with well under half the historical volatility. And from a portfolio construction standpoint, we'd rather take risk where it's better compensated, namely in equities. Now, private credit has been in the news a lot lately, and you've probably seen some headlines. So we feel it's important to put things into perspective. Private credit is simply lending provided by non-bank investors directly to companies outside of public bond or loan markets. As the name suggests, these loans are privately negotiated. They typically offer higher yields and, importantly, are not publicly traded, which means they're less liquid. The main reason the space has grown rapidly is because banks pulled back from giving loans under tighter regulations, and with investors searching for higher income, non-bank lenders stepped in to fill that gap. The biggest question we get is, with some cracks in the market surfacing, is another financial crisis lurking in private credit? And the short answer is we don't think so, especially not anything resembling the global financial crisis. First, while private credit has grown, it still represents only about 4% of the overall economy, far smaller than the mortgage market, which accounted for roughly 70% of the economy heading into the global financial crisis. Second, leverage in private credit is far more contained, around 2 to 1, compared with leverage levels closer to 30 to 1 at some banks back then. And third, ownership is much more concentrated among institutional and high net worth investors. Traditional buy and hold investors who should be able to absorb the volatility rather than being broadly distributed across households. Finally, liquidity expectations are defined up front. Because these investments are less liquid, managers typically limit redemptions, often to around 5%. This is a structure investors should understand going in. So while redemptions have picked up in some cases, and some firms have had to limit outflows, managers so far have not been forced into large distressed sales at steep discounts. The bottom line, while there may be some cracks forming in parts of the credit markets, and these areas do have more risk than the higher quality sectors we favor, we don't see the conditions in place for a systemic event. Now Aaron's going to pick up and talk through equities.
Thanks, Vanessa. Really appreciate it. So let's just jump in here into the equity markets. Feels like everybody's favorite topic recently. Now, as we continue with our theme around soccer, we compare here soccer to a lot of the other sports here in the US, with only about 13 people in the United States that regularly watch soccer, compared with about 44% for football and 30% with baseball and basketball. So the most common complaint is low scoring. A lot of people see soccer as boring or slow. But true fans know that what's missing the point. The real excitement is under the surface. It's the spacing, the passing lines, the runs off the ball. The tactics don't always show up on the scoreboard, but the real soccer fans truly understand. And in many ways, that's exactly what's happening in the equity markets right now. At the maximum pullback, the S&P was off about 9.1% this year, but the average stock was down more than 16%. If we look at the NASDAQ and the small cap space specifically, it was actually even worse. So let's kind of dive a little bit further into some of those numbers. It's always important as we think about pullbacks to put things in perspective. And it's been really interesting fielding some calls from various clients over the last couple of months. And when we look at some of the numbers, as we just referenced, the market was off about 9.1%, max top to bottom, about 5% year to date at its worst point. But if you would have listened into the calls, the feeling, the sentiment felt like the markets were off much greater, maybe 15%, 20 or 25%. But what we've seen so far is not really unusual at all. the maximum drawdown at 9.1%, it's actually below the average inter-year drawdown going back to the 1980s. And so the average S&P drawdown at some point during the year, the market's been off historically around 14% per year. Obviously, it doesn't mean that it finishes there, but at some point during the year, the market on average is off about 14%. And then if you look even further, historically, markets have experienced 3 to 4 pullbacks of 5% or greater throughout the year and one pullback of 10%. So we didn't even quite creep the 10% or crack the 10% pullback in this last downturn we had. We did experience that one 9% pullback. But again, historically, on average, markets tend to do that 3 to 4 times per year, even again in a normal market environment. So market trends, though, tend to recover relatively quickly after these downturns. On average, a 5 to 10% drawdown in the markets tends to recover in around 2 months. A 10 to 20% drawdown in the markets tends to recover in about five months. And then much longer declines, those greater than 20%, think about the great financial crisis or some of the other recessions that we've had over time, those tend to take much longer to work themselves out, maybe take 1, 2, 3 years. But really what we've seen so far this year has not been anything abnormal from a market perspective. Now, if we take a couple of additional factors, this pullback was not an overly significant surprise, and actually some of the things that we've talked about on some of these town halls in previous meetings. Valuations were stretched. The markets had priced in perfection. Valuations were in the upper quartile and the 95th percent quartile. And after that pullback, if we look at valuations today, they're actually below the 5-year average. So valuation today actually looks much better than it did going into the early parts of the year when you look at profitability. Investor optimism going into the year was pretty enthusiastic. We had a change in leadership. There was an expectation that there was going to be a lot more deals done, M&A activity, deregulation, and that was really going to help markets go higher. There was a lot of signs of complacency in the market where you weren't seeing people giving risk as much credence as it needed. That sentiment has really changed. And so if we look at this middle graph here, you're starting to see sentiment kind of slightly below the long-term averages. Not dramatically bad, but again, much more kind of in line with more historical sentiment. And then history tells us that midterm election years, because of the uncertainty, tend to bring increased volatility, especially in the middle of the year where there's more uncertainty around what's coming around elections. So if we look at some of those historical years here on the right side of this chart, looks at the blue line of midterm election years versus the black line in all years, we tend to see a lot more volatility, especially in those middle months within the year. So we'll see how that plays out given we're in midterm election year. Despite that volatility, though, as we look at this next slide here, we're not changing the year-end target of around 7,250. So right now the market's sitting just above 7,000. Our confidence really comes from earnings. We continue to see 10% earnings growth, and the expectation is that continues moving forward here for 2026 into 2027. Historically, if we go back to 2000, the S&P has delivered positive annual returns 10 out of the 11 years when we've got annual earnings growth of 10% or greater. So 10 out of 11, pretty good ratio there. It's also worth noting that a lot of the estimates that Raymond James is putting out there is looking at an earnings figure of around $300 for the S&P 500, where consensus across Wall Street is closer to $319. So quite a bit more growth than even the 10% assumption there. So with that 10% earnings growth assumption, it's a relatively conservative figure when you look across Wall Street. Obviously, if we hit closer to 18, that would be fantastic. And that would create even more tailwinds for the markets to run higher. Somewhat counterintuitively, though, despite concerns around higher oil prices, consensus earnings estimates for 2026 have actually risen 2% since the Iran conflict began. A lot of analysts take time to adjust these estimates after shocks, so we'll see if some of those get adjusted. But if we look back to what we saw in the Russia-Ukraine conflict in 2022, with estimates rose, even eventually drifting lower as the economic impact starts to cycle through. So every cycle is different. We wouldn't be surprised if we see a similar pattern play out. There's so many variables in place that any one of those could change the short-term trajectory. But even with them, we think we're relatively at conservative assumptions at 10% earnings growth. If you take a 24 multiple on that, where the market finishes out somewhere in the 72.50 range on the S&P 500 for year end. Now let's talk about more specifically some sectors within the markets. And over the years, when we've had conversations with clients, a lot of times we've pulled out these Skittles charts that look at the different asset classes and their performance year in and year out. And what this graph is looking at here is a similar variation of that, but it's looking at the top performers in 2025, and then it follows their color into what those markets have done through just the first 2 months of 2026. So this data is just running through February 28th. But you'll see here is that you've got a lot of flip-flopping. We've seen some pretty significant rotation in sector leadership. Last year's winners, communication services, technologies, financials have come out of the gate relatively slow, while energy, obviously, with the Iran conflict and consumer staples have really surged. More recently, though, over the last few weeks, we've started to see some of that leadership rotation flop back, where technologies picked up some momentum again. Those momentum shifts tend to be normal. It's nearly impossible to predict short-term movements in the markets, but it is interesting to watch how some of those fundamentals have played out. We continue to emphasize these sectors, though, with long-term secular tailwinds, strong margins, and durable demand, because there is a lot of uncertainty out there, and so we want some consistency and some durability in somebody's ability to create profits. Those are the sectors with the highest probability of outperformance over courses of an entire year. So obviously, we're paying attention to those daily movements, weekly movements, much more concerned about the long-term trajectory, though, of many of those asset classes. If we take a look at what we would deem to be the captain, technology still remains our favorite or captain of the team. It's the largest sector in the S&P 500. It accounts for about 32% of the index and about 28% of the index's earnings. And over the past decade, it's really been the most dynamic performer. If you think about the innovation in robotics, AI, technology, data center spend, that's really what's been driving our markets here for the last 5 to 10 years. And with forward valuations near the depressed levels of COVID and Liberation Day, we expect technology to reinforce leadership into year end. So although it's lagged a bit of some of those sectors that we talked about earlier, energy and consumer staples, we do expect by the end of the year technology to regain its top performance in leadership. Another sector that we also like is the industrial sector. We think that's a really important sector. It's not always as flashy as something like technology, but incredibly versatile. And with several secular tailwinds, we think it's an important asset class moving forward. The first reason is for defense spending. It's clearly back in focus with the most recent wars in Iran. Recent events have underscored the need to replenish stockpiles of modernized for today's battleships, which include drones, advanced defense systems. While the proposed $1.5 trillion defense budget is likely to come down, that direction is clear. The second industrial benefit from the AI build-out is that AI investment remains strong, and somebody has to build the infrastructure. For the first time in history, we're spending more on data center construction than on office buildings. That's a really meaningful tailwind. The third reason is parts of the transportation complex. From trucking to airlines, they've been under higher pressure with higher oil prices, but as oil starts to normalize with the conflict hopefully coming down in Iran, that will help energy prices, which should create some relief for some of those folks in the transportation sector. Other areas looking for opportunity, every great team needs a few under-the-radar type players. Those ones may not dominate the headlines day in and day out, but they do help with long-term performance. For us right now, that's healthcare and consumer discretionary. Healthcare is trading at historic lows right now as far as valuations are concerned, after a couple years of underperformance with the market. We see a couple of multiple catalysts coming from earnings growth, and then we just have a continually aging demographic here in the US and around the world. People are needing more and more care from a healthcare perspective. And it tends to outperform during election years as uncertainty picks up. Healthcare is one of those sectors that people run to for the defensive nature and the fact that it's not as cyclical with the ups and downs of the overall general economy. On the consumer side, fundamentals actually continue to remain solid. Vanessa touched on some of the tax refunds that are coming in here as we speak. Household net worth is still healthy. Job growth currently remains positive. Important thing to note with consumer discretionary is the most energy sensitive sector in the market, because for most of America, as oil prices go higher, we go to the gas station, it takes more of our dollars. If somebody's living on a relatively fixed budget, that means those dollars have to come from somewhere else, right? And we can't exactly avoid getting gas at the gas station. So that can have some meaningful impact on the markets depending on how long the conflict continues here in Iran. The last one that we'll touch on here is the energy market. And there's obviously many reasons to have questions about energy. It's obviously been one of the best performing asset classes so far year to date. And then the question becomes, do you start to then consider rotating into that asset class if you haven't already been an investor there? We don't think if you haven't already been in the oil sector, the energy sector, that you want to make that rotation in. Oil has obviously risen pretty dramatically, and it feels like every day there's a comment left or right around a ceasefire, and we see oil prices fluctuate pretty significantly. A lot of that is going to be driven by political decisions here moving forward. Historically, moves like that have also coincided with healthy corrections in energy stocks. And with energy expected to deliver its weakest earnings growth relative to its valuations, the fundamentals don't support additional allocation to the energy sector at this time. So now I'll go ahead and kick it over to Don, who will touch on the international sector.
Much appreciated, Aaron. Thank you. So we are going to talk about international now. And if you look at the odds to win the World Cup, the U.S. isn't anywhere near the top of the list. The favorites are the usual powerhouses, several European teams, and Argentina. Even as one of the hosts, the U.S. sits around 14th in terms of championship odds. But when we shift from the soccer pitch to the equity markets, the story looks very different, and we've held this view for a while. We continue to favor the U.S. over the developed markets, and that comes down to a few recent yellow cards being shown overseas, along with some long-standing advantages that the U.S. market continues to hold. First, international economies are far more exposed to energy, especially oil. As you can see in the left-hand chart, the U.S. is now a net exporter of oil, meaning we produce more than we consume. Many countries across Europe and Asia don't have that luxury. Germany and Japan, for example, import close to 100% of their oil. And where does much of that oil come from? Obviously, the Middle East, a region where supply has been severely disrupted by the closure of the Strait of Hormuz. While only a relatively small share of U.S. oil imports comes from the Middle East, Europe relies much more heavily on that region. The same is true for natural gas. The U.S. is largely self-sufficient, while Europe remains naturally dependent on imports. And you've probably seen some news recently about the airline companies in Europe running a risk of running out of jet fuel. This whole issue on the war is getting very, very dire for mainly Europe. Second, energy shock feeds directly into monetary policy. Outside the U.S., central banks are now forced into a much more hawkish stance. Hawkish means tightening. Take the ECB, or the European Central Bank. Because of its singular focus on inflation and now the added inflationary pressure from the war, markets are expecting multiple rate hikes in 2026. Coming into the year, the expectation was that the ECB would be on hold, and the UK is facing a similar dynamic. In contrast, we still expect the US to cut rates at least once, which would be more supportive of growth and risk assets. Third, currency dynamics have shifted. A weaker dollar was a major tailwind for international equities over the past 18 months prior to the Iran conflict. But during periods of uncertainty, the dollar tends to behave like a safe haven asset, and that's exactly what we've seen. Looking ahead, we expect the dollar to be more range-bound, but with a slight strengthening bias. Stronger relative U.S. growth should more than offset lower interest rates as the Fed cuts rates again. Interestingly, this outlook lines up closely with the dollar's path during the first administration's term, which suggests further strength could still lie ahead. For U.S.-based investors, a stronger dollar becomes a headwind for international equity returns. Looking at the fundamentals, the U.S. is expected to post the strongest GDP growth, not just in 26, but also in 27. That should translate into stronger earnings growth and ultimately better equity prices. Beyond the numbers, the U.S. also benefits from some advantages that are harder to replicate, basically the intangibles. First, its geographic position alongside allies reduces direct exposure to global conflicts like the ones we're seeing today in Iran and Eastern Europe. Second, because the U.S. economy is less energy intensive than other developed markets, U.S. consumers should prove more resilient even if gasoline prices rise. And third, the U.S. has greater exposure to powerful secular tailwinds, most notably AI investment and build-out, as well as increased defense spending. And the AI investment build-out is past $1 trillion now, and I think I saw an article on the defense spending, they're asking for $1.5 trillion in next year's budget. And finally, the U.S. is home to larger, more profitable, globally recognized companies that have demonstrated staying power through multiple cycles. Outside the U.S., we continue to favor emerging markets, particularly Asia. Asia remains tightly levered to the global AI investment cycle, which we can see in the rising market cap weight of technology. Earnings growth is expected to be strong, nearly 40% in 2026, with positive momentum coming from upward revisions over the past few months. Even after the strong performance over the past 2 years, valuations remain attractive relative to history as long as the end game in AI does play out. We believe emerging markets are well positioned to bounce back more quickly as geological, political begin to de-escalate. Oops, sorry. We'll close with asset allocation and why it's important to keep a strong focus and stay disciplined. For example, soccer star Lionel Messi spends most of a match walking, 90% of the time, reading the field, conserving energy until the opening appears. Then he strikes. Markets work the same way. Volatility is normal. In fact, the S&P 500 has spent about 70% of the past 25 years going sideways, sometimes for a decade at a time, like in the early 2000s. Yet nearly all the returns came during a handful of short, powerful bursts. No one knows when those moments will show up, which is why staying invested really matters. When you combine the ups and the downs, the long-term result is still about an 8% annualized price return, close to 10% if you include dividends. The key isn't chasing every move, it's staying on the field for when the opportunity finally comes. Messi is also constantly scanning the field, not just watching the ball, but tracking where defenders are, where the open space is, and where the next opportunity might emerge. In fact, studies show Messi scans the field about 5 times in the 10 seconds before he receives the ball, compared with less than 3 times for the average player. Over the course of a match, that adds up to nearly 700 scans. That's anticipation at an elite level. That's the same standard we apply to markets. We're constantly scanning the economy and financial markets in real time, looking for signals that either reinforce our views or challenge them, and being ready to adjust when the facts change. The key is staying alert without being reactive. The biggest mistakes investors make is the knee-jerk reaction at exactly the wrong moment. Here's a great soccer parallel. On a penalty kick, the most successful place is right down the middle. Why? Because goalkeepers dive left or right about 95% of the time. If you go straight down the middle, you score roughly 80% of the time. Thus, similar to investing, a balanced, long-term approach is smarter than making knee-jerk reactions. And with that, Varen, Vanessa, and I would like to thank you once again for joining us and look forward to seeing you on the next town hall in the coming months.